we will have a topic, as we already informally discussed, is about how to promote inter-regional or regional trade within an African continent. And the angle of promoting this trade is from financing, and not only the formal financing, because as people know that the formal financing is actually very limited in some countries in Africa. So without access to formal financing, informal financing became very, very important. And they take over the daily, transactions, the trade, etc., etc. And this type of informal financing today, Professor George Bongomin is going to talk about is mobile money. So I understand that the proposal is to try to combine or integrate between the banking sector and mobile monies network, so that they can work together and they get rid of the borders, and then they can improve inter-regional trade. And as people may know, we just had our annual conference with other organizations. We focused on fragmentation, geopolitical fragmentation. And I think the topic is so timely that if you do this properly, integrating the formal banking sector with the mobile sector, then informal sector, then probably you can overcome some fragmentation. And fragmentation, is mainly from outside. So that requires further development of regional things. And that regional things, particularly in Africa, is African Continental Free Trade area. So I think I can make the connection between the current affair and this topic, and I can see a lot of issues that can be discussed. So our presenter today is Professor George Bongomin, who is a professor at the Faculty of Graduate Study and Research and the Finance Department in Makerere University Business School, Uganda. So as I just confirmed with George, actually George has been our friends, CGF friends for many years. And last time when George was in London, we had, together with Professor Victor Murinda, we had a book launch event. So as you can see, George has done quite a lot of research in different areas, including financial inclusion, fintech, microfinance, climate finance, and business philosophy. So quite a big coverage of his research. I will not go through all the journals that George has published, but they are in our message, so you can read them. And George is connected with other universities within Africa and outside. Also, I can see that George has a lot of experience in managing or as a PI of very big, very important research projects, including the UN, including the World Bank project, EU project, MasterCard Foundation, etc., etc. So without further ado, I will give the floor to George, and and George agreed that if there are some questions during his presentation, we can have some interactions. So George, welcome, and the floor is yours, please.
Yes, thank you very much, Chair and Professor. Uh, Today, we would like to look at one of the key issues that can support the growth prospect of the African Continental Free Trade Area, as hinted by the chair. So, our main concern today is to look at the topic as we can see, fueling sustainable digital future for intra-African trade, using mobile money interoperability to increase the trade prospects of the African Continental Free Trade Area. So this is a policy paper that we've really worked around with a number of colleagues to ensure that the issue of accessibility due to the use of digital innovation can actually be advocated for to promote access to financial services. So as we well know that we have the 17 goals that have been set by the United Nations, and the potential development outcomes linked to these goals can only be realized if the active economic agents have access to cheap finance. Now, this can be achieved through what we call universal financial inclusion, since it can support the inclusive development agenda, which intends to leave no one behind by the year 2030. Now, an inclusive financial system can facilitate efficient allocation of productive resources, which in turn actually reduces the cost of capital, which is used for trade. Now, you find that the availability of a wide range of financial services can actually economically promote the well-being of individuals. Now, this comes as a result of access to finance, which is without price and non-price barriers. Now, this economically empowers individuals through trade, which in essence has been advocated for under the African Continental Free Trade Area. Now, you clearly know that finance is the lifeblood of any trade activities. So the economic agents require what we call some kind of banking infrastructures to gain access to convenient and affordable finance to support trade. However, when you look at the latest World Bank Global Index report, which came out about 3 or 4 months ago, you find that although 5% of adults globally have benefited from access to financial services from the year 2021 to 2024, still we have about 1.3 billion adults who remain without access to formal finance. Now, within the sub-Saharan region, sub-Saharan African region, you'll find that 20% of adults still do not have access to finance to support exchange for goods and services. Now, this arises due to one, cost associated with the access and usage, then the distance to the banking facilities, and then documentation requirements, which have actually led to exclusion of the geographically dispersed economic agents. But you find that due to the current digital innovation, over 900 million adults in both low-income and middle-income countries owns mobile phones, and about 80 million adults in sub-Saharan Africa own the mobile handset. That can actually act as a tool for accessing financial services in the absence of closer financial infrastructures. Now, when you look at this current statistic, this is the latest statistic showing account ownership, which actually cuts across the different continents in the world. But you can clearly still see that when you look at the different regions, based on the availability of the data from the Global Index, you see that there is still discrepancies or fluctuation in account ownership, which is the determinant of access to financial services, or it's used to measure or determine the number of people who access financial services, meaning that a certain percentage of the global population still remains without access to financial services. But due to the existence of mobile money, you find that since many people in Africa, for example, own mobile phones, the mobile phones can actually help to remove the barriers such as cost, distance, and documentation requirements. Now, mobile money actually can help the users or the population that are without access to financial services from the banking the banks to actually access financial services in a cheaper, convenient, and secure manner. And again, also the mobile money can actually help these individuals to store, send, and receive money instantly without a bank account. Besides that, you can also see that the use of this handset can help this individual to leverage cost and geographical barriers in terms of distance. Besides, the use of the handset, which now these individuals can use to transact through the mobile money accounts, can also be used as a transaction trail or records. Then they use this for borrowing from the financial institutions. Now, you will find that due to all these advantages of mobile money, many bank mobile money subscribers, including the traders, still face several problems, with the network failure and connectivity being the main one. Now, you will see into it that we have what we call digital interoperability. So the digital interoperability between the different networks or provider of the mobile money services helps to create some kind of hub that connects the mobile money accounts and the banks, which allows what we call account-to-account inter-network transfers of funds, which in essence can support traders who do not have access to finance from the physical or the conventional banks. Now, when you look at this overview of the latest statistic and data from the Findex, you will see that worldwide about 86% of adults own mobile phones. Now, this shows us and gives us the urge to suggest that people who own mobile phones have the potential to use it to access financial services. Now, when you look at Africa specifically, which is the main focus this afternoon, you will see that when you look at the ownership of mobile phones in 2014 and then 2024, you will see that there has been increase in ownership of mobile phones, and then the accounts, the mobile money accounts, which are actually registered through the SIM cards. So this actually gives us a better position to suggest that adopting and using mobile phones, which have interconnectivity across different networks, can actually provide a better means or strategy for actually promoting access to financial services. Now, from the overview above, you can clearly see that Sub-Saharan Africa remains with the highest mobile money accounts when you compare it with the rest of the regions in the world. You can see that the mobile money account only is more higher in Sub-Saharan Africa, meaning that the population in Africa, including both the rural and urban, they use more of mobile phones to access financial services. Now, these owners of mobile devices, they actually, when you look at the distribution based on regions of Africa, you can clearly see that at least on daily basis, most of the population in Africa across the different regions use their phone on daily basis, as we can see from this statistic. Now, this means that, this implies that the adoption and use of mobile phones can provide a better way that the traders in Africa can use to access finance that is not provided by the physical banks. Now, moving forward, you can now see, because these mobile phones can be used for three activities. One, we can use the mobile phones for savings, then for payments, and then for borrowings. Based on this statistic, we can clearly see that from the data that was collected through the Findex, you see that mobile money has been greatly used for savings among the adults in Sub-Saharan Africa, meaning that most of the people who have been financially included between 2021 and 2024 own mobile money accounts, as we can see from the last section of this graph. And then when you come down, based on 3 countries that were selected from this study, you see that in Ghana, Kenya, and Uganda, more than 20% of the adults borrowed from their mobile money providers in 2024, as we can see. And you can see that, for example, when you look at Uganda, you can clearly see that there is higher lending, digital lending, which has actually escalated higher borrowing among the individuals. Then when you come to digital payments, you can clearly see that in sub-Saharan Africa, majority of the individuals use this kind of platform for digital payments. Now, based on the use of mobile money, of course, we need to actually do some kind of information exchange to receive and then send money through text messages. Now, based on the different regions of Africa, you can see that most individuals use their mobile phones to receive and send messages, as we can clearly see from this graph, with, of course, South Africa having, East Africa having the more use of text messages, followed by, of course, West Africa. Now, because of the advocacy by the African Continental Free Trade Area to remove barriers to actual trade activities to increase exchange of goods and services, you find that integrating interoperability can actually promote accessibility to funds that can promote trade activities between the traders within the continent and across the continent. However, you will also realize that one of the key issues under the African Continental Free Trade Area is the formation of single market regime to drive the trade and also to promote the smooth integration based on the exchange of goods and services. However, based on the previous statistic that we've seen, you still see that there is lack of finances among the traders. Now, when you look at the setup of the African Continental Free Trade Area and you read the background and the history, you will find that the technocrats and the people who designed the African Continental Free Trade Area forgot one thing. They did not have what we call a predefined or defined banking infrastructures to meet the financial needs of the unbanked traders from its inception. Now, meaning that with the increasing stringent conditions set by the former banks, you'll find that the traders are locked out and they do not have finance for trade. Now, as the innovation in the digital world grows, you will find that adoption and use of digital innovation like mobile money can create some kind of accessibility to finance without the physical banks. And this can actually help these traders to access finance. However, as we can see, we see that the mobile money, of course, has a lot of challenges. But you see that one of the issues that has really made it very difficult for the users of mobile money in the rural areas to access finance is a problem with the connectivity. Now, when there is some kind of interaction or the link between the different network providers and then the banking system, you will find that there is actually a balance. This interoperability strikes a balance between the demand and supply for money that can actually be used by the traders. So meaning that the traders who adopt and use mobile money that are having some kind of interconnection between the different suppliers or the mobile money providers can actually easily have money for trade. Now, briefly, this is some sort of the interoperability hub. Now, the interoperability hub link the mobile money subscribers to the banks, where they create some kind of a settlement hub, meaning that the mobile money users like traders who have money in their phones can easily actually have a link with the bank, and the demand between the money and the supply can easily actually be interconnected. So this hub helps to create some kind of a settlement. This is like a settlement house where the people who have money on their phones can easily have can meet the demand and supply for money because of that kind of interconnectivity between the mobile money accounts and the banks. So we can clearly see this kind of interaction in terms of digital interoperability. We see the sending of the money, which has already been stored by the users, and then you have some kind of the gateway or hub where the two meets, where the money which is in the mobile wallets of the subscribers are actually having some kind of interaction with the banking system, and then the users can interchange or exchange the transfer or receiving of money from both ends. So this is some kind of a settlement hub which can only be possible through digital interoperability, which can solve the problem of network interconnectivity, especially in rural areas where the traders reside and with limited access to banking facilities. Now, this kind of argument is backed by the volume of trade the volume of exchange of money that actually has been witnessed between 2019 and 2023. Drawing from these global transaction values of digital interoperability, you will see that we have three categories of interaction between the supply and demand for money. So we have one, the person-to-person mobile money transfer, and then also we have bank to mobile, and then mobile to bank. So from this graph, you can clearly see that the volume or the values of money that has been actually transacted through the interconnectivity between the different networks actually has been increasing. You can see for person to person, between 2019 to 2023, there are over $53 billion that have been transacted. And then bank to mobile, we have about 900, actually have $97 billion that have been transacted. And then between mobile to bank, we have 113 billion, meaning that the people who are the mobile money subscribers sending their money through the banks are more. And this actually gives us a point of argument that adopting interoperability can actually promote trade under the African Continental Free Trade Area. Now, when we look at both innovation, you will see that both the mobile money and the digital payments interoperability have limitation. So this kind of arrangements have been limited by a number of factors. One, the cost. The cost is still high from both the demand and the supply side, but specifically from the supply side, we'll see that there's high tax burden on the businesses or traders who use mobile money and digital payments under the interoperability. Then also there is a challenge of the inclusiveness to access and use. There's still a problem with the gender bias, and then also urban and rural divide, meaning that most of these people who can easily access this kind of platform are more or less urban-based than the rural-based. And then also the SIM card registration requires some sort of identification. And you see that most of the countries in Africa still do not have the national IDs distributed across the population, both in the urban and then the rural areas, which limits the registration for SIM card. And then, of course, what has become very common these days is the digital lending. Now, you find that the digital lending aspect has also faced a lot of problems. And one of the biggest challenges is the high interest rates on the digital loans. And then also the difficulty in identifying and verifying the creditworthiness of the digital borrowers, alongside the difficulties in monitoring and enforcing the digital loan repayments. Besides this, you also see that since we are looking at some kind of African integration, we see that in Africa, the countries are still having different regulations. So this, in a way, can affect the formation of the single market regime, because we still have a challenge of lack of standardized digital protocols and compatibility to actually ensure some kind of uniform digital regulations. Now, besides all this, our population in Africa still face a problem of limited digital skills and a problem of limited financial knowledge and skills to manage this kind of innovation. So briefly, as we sum it up, you see that for policy to promote adoption, one, of the mobile money, and then two, to take up the interoperability components, we suggest a number of strategies that policy can take on to ensure that the traders who are engaged in the African continental free trade have access to finance. So one of the issues is, like, when you look at the high tax burden on the businesses, so the stakeholders, like the different ministries, like the Minister of Finance, the central banks, and then the revenue authorities, should actually try to investigate the origin of cost on access and use of digital financial services to see where are the costs originating from when you look at the supply side and then the demand side. Now, based on the issue of gender bias and digital divide, there should be some kind of a platform where the private sector needs to work in hand with the public sector through what we call the public-private partnership to develop some kind of external kind of, perhaps if you have digital public infrastructure extended into the rural areas. Now, through these infrastructures, the population, all the population can be included, including, of course, the women, the youth, and then the men. Besides, as a result of limited access to identification documentation, we suggest that there's need to strengthen the national identification system. And what can happen is that countries in sub-Saharan Africa should, of course, have some kind of biometrics. These biometrics can be used for identification, and the traders who would wish to borrow money can actually use their biometrics to access financial services. And then again, when you look at the issue of the high interest rates on the digital loans, and then the difficulties in verifying the credit worthiness of the borrowers, and then monitoring and, of course, enforcing repayments, there is need, of course, by the central bank and then the other regulators to monitor interest rates on digital lending. Perhaps when you look at the central bank, like in Uganda, which is the overall supervisor of the digital ecosystem, which includes the mobile money, they should actually have some kind of routine monitoring of the interest rates that are charged on this kind of loans. Then also, the differences in the regulations, when you look at the advocacy by the African Continental Trade to set up a single digital market, this means that the different countries should have some kind of a single digital regime and some kind of the legal framework that can support the mobile money and the interoperability system of this kind of platform. Then lastly, when you look at the issue of lack of digital skills and then the limited financial knowledge and skills among the users, there is need to develop some kind of inclusive kind of financial literacy and digital literacy curriculum that can actually be rolled out to integrate the different section of the population. Now, through this, the traders can, of course, acquire skills that can help them to participate over the mobile money ecosystem. So, based on this, we believe that the opportunity to increase trade under the African Continental Free Trade Area can actually be achieved. Based on the current statistic that we've seen, that still about 1.3 billion adults still do not have access to financial services. Of course, you will find that statistic also shows that about a big number or percentage of traders also still suffer from over 1.5 billion gap in financing, especially in sub-Saharan Africa. So conclusively, we think that one, digital transformation through the interoperability has potential to foster sustainable development by enhancing regional connectivity and unified single digital market. Then, of course, we believe that the digital interoperability can help traders to actually access customers outside the digital providers network by expanding access to account payments that can actually make fund available. Now, this fund can help to promote progressive trade. Then we also still think that interoperability can allow more funds to enter into the digital financial ecosystem to facilitate trade. Of course, in a nutshell, when you look at this kind of arrangement, it can efficiently facilitate both local and cross-border exchanges more than the physical cash. Now, this means that the traders can expand on their trade activities within the continent and beyond, since they can do some kind of remote payments for goods and services. That, of course, we still see that this kind of arrangement can be affected by system redundancy and outrages. As you know, in most parts of Africa, we still have problems with the power, electricity. So sometimes when there is no power, you find that the system, we have what we call the system, the turn down of the system. So this affects the efficiency of the mobile money and, of course, the digital payment through interoperability. Then, of course, the tax regime on the digital, financial transactions through the different digital innovation still remains expensive to subscribers. Although governments within the sub-Saharan Africa have worked towards reducing these taxes, users still find it high. Now, besides that, because now you find that there is common lending through the mobile phones, the interest rates still remain high. This presents an obstacle in actually making finance available to the different traders. Then, of course, this goes hand in hand with the default rates of these loans, which has also affected the capacity of the lenders because they cannot monitor the repayment of this kind of digital loans. Then, of course, within the sub-Saharan Africa, culture still plays a great role from all aspects, all walk of life. Contextually, you see that most women still do not own mobile phones. And even if they own mobile phone, the SIM card registration could still be in the names of the household head, which is the man. So with all these kind of conclusion, we still strongly believe that if governments within the sub-Saharan Africa works hand in hand, then there will be some kind of formation of unified single digital market, which of course can make finance available to the traders. And this, of course, will actually promote the goal of the single or the unification or of course, having a single kind of market that can drive activities through trade under the African Continental Free Trade Area. So members, this is briefly our presentation, which we had for you this afternoon. So I would like to end here and hand over the floor back to the chair. Thank you very much.
Thank you very much, George. It's straightforward presentation, and it is a policy-orientated paper. You put forward your argument that mobile money is actually very helpful in promoting trade, based on the descriptive statistics. So you saw some trends and then you saw this is important. So, and of course, I would like to see some evidence, or even more formally, systematic evidence to prove that indeed, it is mobile money that is promoting trade. And I'm sure it is promoting trade. But I was wondering, you actually mentioned a key term in your presentation, and that is interoperability. I thought this term refers to the joint between, or the joint point, or the cooperation between the formal banking sector and informal banking, let's say mobile money in this case. So, but it is not so clear to me what you meant by this interoperability and how this mobile money network, informal part of the financing, is integrated with the banks, with formal. So imagine if a farmer who has no access to the formal financing, and of course, mobile money is helping. I mean, they can do very small scale transactions based on only the mobile transaction. But I would like to see the comparison between those traders that have no have no access to the formal financial system, and the traders who have both, who have mobile money and also have access to the formal banking finance. So, and that type of things that I was thinking about. So my first comment or question is, can you maybe explain a little bit more about whether or not there is a connection between formal banking sector and the mobile money transactions?
Okay. Yeah.
So that's my first one, and then we go to the next one.
Thank you. Thank you very much, for that observation. Yeah, actually, what happened is that, you see, the formal banks tend to have stringent conditions for the rural population or people who do not meet the requirements. Now, this makes them to be locked out of the formal financial system. But this kind of population actually owns mobile phones or the mobile handset. Now, what happened is that they go to the mobile money provider, and then they subscribe by buying the SIM card, and this SIM card, or using the SIM card that they already have initially in their phones, that they use for making telephone calls. Now, this SIM card is then registered onto the mobile money account. Now, this mobile money account is offered by the mobile money providers. Now, these mobile money providers have connection or are linked to banks, you see. So the banks now provide the money that they subscribe, that the mobile money providers now actually give, or they use it to actually provide finance on the mobile money account of the subscribers. So through what we call the mobile wallets. So if I have a mobile money account, I will have what we call the mobile wallet. So my mobile money wallet means that if I have money, I go to a mobile money agent, and this agent will deposit the money onto my mobile wallet. In that process, the money that is put onto my wallet comes from the mobile money provider, who in essence accesses this money from the formal banks. So this is the kind of connectivity between this kind of transaction, meaning that somebody who has been locked out or formally financially excluded can still access money from the formal financial system through the mobile money providers, which then gives them money when they take their money to the mobile money agents, you see. So this is the kind of connectivity that makes the two interlinked. Now, how does the interoperability comes in? the interoperability comes in because we have different mobile money providers. Like, for example, in Uganda, we have the different telecom companies. We have the mobile telephone network, which is MTN, and then the Airtel. So these two companies both offer the phone call service and then the mobile money service. Meaning that somebody who has a mobile phone handset and has a SIM card from any of these two companies can then register and have a mobile money account, you see. But this could be people who have been excluded from the formal financial system. But of course, it can also have people who still use the formal banks. So both categories of people can still use this platform to access financial services. Now, the interoperability component comes because sometimes you'll find that one network, like for example, you will find that Airtel might not have the network active in a specific area. Then MTN can be active. So because of that cross-network kind of interoperability that are interlinked, these kind of people can still access their money and then use it, for example, for buying goods and services or for trade in this kind of scenario. So that is how it works out. And of course, your observation is very key. Trying to isolate a group of individuals or the population that purely use mobile phones to access financial services, and then those that use their mobile phones and also as well use the formal banks. So this kind of scenario, of course, exists. And when you look at the current Global Findex report, this kind of information is available, where statistic is showing the number of individual adults that use this kind of scenarios or subscribe both to mobile money, and then they also use the formal banking system. And those who actually purely use the mobile money kind of access to financial services. So briefly, that is what I can say. Thank you.
Okay. So thank you very much. So that's why I'm thinking. So for myself, I may have access to both mobile money payment and also my bank digital payment. So
exactly.
When I do the transaction, I will forget about when I do larger amount of transaction, I will use my bank account and to do the payment rather than to use my mobile money, and that shows that formal financing is more important than mobile. Mobile money probably is helpful, but only on a smaller scale. So my point is, if we are promoting the integration, we still need to develop the formal financial system, banking sector, to be able to promote economic performance and trade, etc. And those should be the force rather than mobile network. Do you agree with me?
Yeah, you see, I don't purely agree with you totally, because you see, as you see from the statistic, majority of the people are excluded from the formal system. So these people have mobile phones, you see. So meaning that much as the formal financial services exist, the number of people who have been excluded by these formal financial services or from the formal financial services by the formal banks are actually more than the people who own this account. So for you to strike a balance and have efficient exchange or trade, you need to actually have the people who are on the other side, who are financially excluded from the formal system, and then on mobile phones, actually, to their own mobile phones to actually have what we call the mobile money accounts, you see. So these mobile money accounts will then support the people who you believe to be operating formally to actually transact with the the majority, perhaps the traders, who are excluded from the financial system, taking into account that, of course, well knowing, like in the sub-Saharan African region, one, the cost based on the affordability, when you look at the transport cost, and then, of course, the fees to the banking is not like in those developed countries, you see. And then when you look at the distance, the geographical dispersion of the banks, you find somebody will walk, of course, like 5 to 6 kilometers to find a bank, you see. Then also, when you look at the documentation requirement, most of these trade, of course, we have also the informal trades that are already participating on the African Continental Free Trade, you see. So this kind of arrangement makes majority of the people to be on the other side who are excluded, but they own mobile phones, you see. So meaning that, of course, you know, the formal banks always operate based on the kind of risk of the customer they serve. So since the customers might not meet certain requirements, perhaps the documentation, and then the certain criteria for selection, you will find that majority are excluded, as seen from the latest findings from the global Findex. Thank you.
Yeah. Okay. And so I think we can open the discussion to the floor. And but do keep in mind that George, the cost of borrowing mobile money transaction is higher than the normal interest rate. So for the traders. So can we have?
Yeah, it is true. Actually, I for one, to be honest with you, is that when you look at the mobile money, there are a lot of issues and debate around the cost. Because one of the issues that we've been recommending to policy is that to have some kind of standardized fees. Now, like in Uganda, when you want to withdraw money from your mobile phones, the amount, the charge depends on the amount of money that you will withdraw, making it, of course, very expensive. So there is some kind of need for uniformity in the cost of this kind of service. Yeah, I totally agree with you, of course.
Yeah, so let's collect some more questions and see how we have different perspectives on this issue. Do we have any comments or questions? Oh. Yeah. Okay. So thanks, Martin, for rescuing me. Martin, can you come in, please? Yeah.
Yeah. Can you hear me?
Yes, we can hear you.
Okay. Yeah. Thanks. And George, can I follow up on what we were just discussing about the cost and the interest rates? My questions are the following. First of all, when somebody borrows through the mobile money, that money, I presume, is coming from the bank which is partnering with the mobile money provider. Now, does all of the interest, for a start, what is the interest that they are paying approximately? Or what sort of range do we know about the interest rates that they are paying? Secondly, does all of this interest income accrue to the bank which is lending the money? Or is the mobile money provider also taking a cut of that interest income? And also, presumably, the traders who are borrowing money through the mobile money service are borrowing much larger amounts of money than our individual customers who may be just borrowing for consumption purposes. Are they paying different interest rates to the individual customers? And what are those interest rates? Thank you.
So thank you very much, Martin. This is really a very good kind of question. You see, like I will start with the issue on the interest rates. You see, depending on the different countries, like for example in Africa. Now, like in Uganda, you will find that people do not specify They do not have some kind of specific reasons why they need to borrow this kind of money. That is one. Now, then two, there's what we call the borrowing, the amount vis-a-vis the borrowing period. Now, these telecom companies, because of what I could say weak monitoring and supervision system, you'll find that they manipulate the customers. In fact, the interest rates that is declared formally to the customer before borrowing actually is not the real interest rates that is charged on the customer after the period, you see, which the period within which you need to pay back this kind of digital loans. So what happened is that when the customer stays for a longer period, like of course they can borrow for 30 days. So beyond 30 days, before 30 days, the borrowing terms can be like, let's say 15%. Now, after the 30 days, they can double it to 30%. You see? So when the customer or the borrower is paying back this money, they have to pay it back with the 30% interest. Now, what happened is that these borrowers can actually, what is really, this is happening in Uganda, it's a common practice. The borrower will pick the SIM card and then discard it or keep it away, you see? Then acquires another SIM card that they will be using. And then what we need also to note is that most people in Africa own more than 2 SIM cards. So they will keep the other SIM card without any kind of activity, which means that one, the lender is losing the money, and also the borrower is accumulating more interest, you see. Now, there is no some kind of streamlined platform where this kind of borrowers can be followed up and then forced to, or some kind of enforcement for the borrowers to pay back this money. The only thing is, if the borrower receives money on their funds, then the system can automatically make deduction. You see, that is it. Then also, we need to know that these telecom companies, you know, of course, I wouldn't want to go so much into it because of political issues. Most of these telecom companies bypass a lot of laws. So they manipulate the customers. And actually, even the interest rates that they get becomes, of course, like abnormal profit to them. You see, so this makes it a big challenge to both the borrowers and then the lenders, because from the borrower side, the lender will charge more or high interest because they automatically expect that the borrower might default, and then from the lender's side, you will find that they also suffer from default risk, making the digital credit portfolio to be poor. So these are some kind of scenario that is really happening. And in a way, this can affect, of course, what we are trying to advocate for, to promote the growth or the prospect of the African Continental Free Trade Area. Thank you. I hope
George, can I have a follow-up?
Yes, a follow-up.
Yes. When the bank, presumably the money which is being lent to the mobile money customer is coming from the bank. So does the bank lend? Does the bank lend to the mobile money provider, who then lends to the customer? Or in the bank's books, does the bank have a claim on directly on the mobile money customer?
Actually, what happened is that the mobile money providers, these are companies. They are telecom companies. So these telecom companies will have funds or accounts with these banks, and they have money. They have money in these banks. So they use their money that are like their deposits. Then the bank use this deposit, which is for these companies. Then the companies use it to lend to. The company actually use their money that is deposited in the bank to lend to the borrowers. Of course, I don't know perhaps if the mobile money companies are having overwhelming borrowers, then perhaps they have some kind of arrangement where they can also as well borrow from the bank to lend to the customers. So perhaps there's that kind of arrangement too.
So in fact, all of the interest income is going to the telecom company.
Exactly.
Okay. So in fact, the telecom company is acting like a shadow bank.
Yes. Exactly.
Yes.
Exactly. That's a type of P2P. That's a type of shadow banking, and that is out of the regulation. And that's why I think if I have other options, I probably would be very careful in taking up loans from this type of thing. But I can use them as a small scale daily transactions and for convenience and et cetera, et cetera. So that's my observation. Do we have more comments or questions to George? No? Okay. So George, I was thinking about the infrastructure side of the story, and to be able to develop or you are proposing, look, we should promote this the usage of mobile money so that it can promote trade. And I was thinking those providers, those let's say whether they are telecom companies or they are some kind of platforms. So do you think there will be, or there is already a kind of restrictions in terms of the connectivity or availability of telecom infrastructure, so that you need to have this kind of setup to be able to use the network? So who are they? Do you think there is an issue on the infrastructure side?
Yeah, of course. You see now what is happening within Africa is that the government, through the communication commissions, are now setting up what we call the digital public infrastructures, where they have centers. Yeah, they have centers that are having some sort of, they have like a center or a hub where the public can go and access the different kind of services that can promote access to the digital platform. Now, through these centers, they also roll out what we call the digital literacy and of course, digital financial literacy. Now, there is, of course, a great need based on the current advocacy that the governments in Africa should set up this kind of infrastructures. So there is great need because they are lacking. So it's really something which is as well very important, because most of this, like when you come to Africa, most of the population lives in the villages or the rural areas. Now, within these rural areas, the individuals suffer from different kind of challenges. One of the biggest challenges is how to charge the mobile phones, you see, because they do not have energy or access to power or electricity. So if you have this kind of a center or infrastructure where people can go and charge their phones, they can also get additional information on the services being provided by the mobile telecom. So this actually will promote one, of course, more access and more usage. So what I would say is that, for example, in Uganda, the government is actually trying to work through to promote what we call public-private partnership to set up a digital public infrastructure to promote, of course, the use of telecommunication resources or facilities.
Okay, so that you agree that is a very important issue, and particularly for African countries. Yeah. So do we have anything else to discuss? Okay, so if everybody is happy about the status of our discussion on this topic, I think probably we can conclude this session. And I would like to thank everybody who are here. And I know people are very busy at the end of the semester. And George, thank you very much for your contribution to this seminar series. And I think the topic is absolutely important, but there are so many other issues that are involved, and we can further continue our discussion offline and it may be in the near future. So thank you, everybody. So George, do you have one sentence to conclude the session, to finish the session?
Yes, thank you very much, Chair, for giving us the opportunity to share with our colleagues this policy brief. So we think that we need to do more kind of investigation to really find out what are some of the key issues that can support the digital innovation or the fintech, in of course ensuring that majority of the people in sub-Saharan Africa and elsewhere who still do not have access to financial services, but on mobile phones and internet connectivity, can still use this opportunity to gain access to financial services. So I think that institutions, advocates, and perhaps like in Africa, the African Union should actually do more kind of research to find out how the common man can use their mobile phones to access financial services. So with all this and this brief conclusion, I would like to end here, and I would like to thank all the participants and thank the chair for giving us the opportunity to make our presentation. Since you gave us your slot to make this presentation, you honored us, and this was really very kind of you. We shall always pledge to contribute to the weekly seminar at the center. Thank you very much.
Thank you, George. And I hope we can see each other in the near future. And thanks everybody for your time. I will see you next week. Okay. Okay.
Yes,
bye bye.
Thank you very much.
I can conclude.
Bye bye.
Yeah. Thank you. Bye.